Fourth consecutive month in our index of a deceleration in the inflation rate. We're down to 4.5% year on year. The previous revised figure was 6.9% year on year for August. So it's coming down at a steady rate now, and I anticipate some house price deflation on a year on year basis by around about year end or early 2011.
The bottom line, do we not buy houses at this stage? We wait until we see some bottoming out, or are we close to the bottom, in your opinion?
It's always a tough one to time the bottom of cycles, and obviously there's a lot of distressed selling at the moment, which makes for good buying in a lot of cases. So it's a tough one, but I do think that next year in 2011, for 2011 as a whole, we've got a period of house price decline again. We had one in 2009.
So there's no rush, in other words, that's what you're saying?
Well, it would seem that way, yes. It doesn't look like there's a rush. It looks like the market's going to be weak for quite some time to come. And really, that's a function of our economy. There's nothing obvious to me that's really looks like...
stimulate demand at this point.
Yeah, it's going to really stimulate demand. Yes, we've had interest rate cuts, and yes, there is a possibility of some more interest rate reduction. But the real problem is the household sector is highly indebted these days. So a number of years ago, when we had the last interest rate cuts, the household sector could increase its borrowing rapidly. This time around, it's not the case. They have increased it a little bit, but by and large, they're a stressed household sector. They're under pressure.
It'll be interesting to get your house view on interest rates. Obviously, that has a direct impact on house prices, and I think there's a renewed focus on it with the current levels of the rand. And surely that should be a boon for house prices if rates are cut further.
Yeah, I think well, our group view is actually for no further interest rate cutting, a sideways movement till well into next year. But I think if anything, the bias and the risk is downward. Certainly it doesn't look like it's upward at the moment. I don't think you can rule out the possibility of another 0.5 percentage point cut at the next meeting.
What about the lag effect, if I can just jump in there, of the interest rate cuts that we've seen to this point? Since December 2008, we've seen 600 basis points. Yes. Coming off local interest rates. Is there not a lag element that is going to give that kicker to the housing environment?
I don't think in the housing. I think the housing and the new vehicle sector, to name two, they're very credit driven, and they're probably the first to respond. A rule of thumb which is often mentioned is 18 months to 2 years for the full impact of interest rate cuts to come through into the economy as a whole, and there are some lagging sectors which still have to feel it. We are leading sectors. The biggest impact, I think, was felt straight away, very soon after the big interest rate cuts up till August last year, those 5 percentage points worth. You saw a big surge off a low base in new mortgage grants, growth in new mortgage grants. That peaked somewhere around about April, the year-on-year growth at about 89%, growth in value of new mortgage loans granted. And that tapered off that growth rate tapered off steadily in the second quarter to about 24%. So we're already seeing the decline. I think the bulk of the big interest rate cutting, the effects of that have already been felt.
Is there a disconnect between what we're seeing on the residential front and commercial and industrial property?
I don't think a disconnect. The commercial property has slowed as well. Perhaps there wasn't as big a oversupply created in commercial and industrial property, but certainly we did see vacancies rise there. It is a weak market at the moment, and it typically tends to lag the residential property a bit. So it's our indices that we have show that there has been some recovery, some decline in cap rates during that mini recovery early this year. Some improvement in capital growth, but I think it'll follow the same trend. Around about now, probably peaking in terms of capital growth and total returns, a mini recovery, and then a slowdown again as well.
In terms of contrary trends in relation to the value of the underlying properties, are there any particular segments which are growing at a faster or a slower rate?
Well, I think if you look at residential property, I think it was more the affordable housing space that still has had some legs. Look, they didn't escape the slowdown in the recession of 2008, and there was even some capital depreciation there. But I think it's a less oversupplied sector. And what we saw during this, what I call the mini recovery up till about mid-year, was a faster recovery and a better house price growth rate in the affordable segment. So it was the lower end, I think, that performed better. But I think the trends are very similar, all starting to turn downwards, just that the affordable segment held up a little better.
John, thanks very much for your time. John Lewis is a property strategist at F&B Home Loans. Still with me is Simon Filmore, the CEO of Independent Securities. What, in your opinion, offers value on the current market spectrum? Something like Sasol is being touted as a value play out there?
Yeah, I think there are numerous examples of value. Obviously, in the short term, from a pure technical and trading point of view, the market is quite overbought because of the 10% odd run that we had in September. But if one looks for the long-term investor where you're able to take a buy and hold type view, I still think there are numerous examples out there. And
buying opportunities still in this environment.
Yeah, I think specifically through the September run, we saw the industrials, financials run quite strongly, and the resource counters lagged them quite significantly. So things like Anglo's Bulletin, although they did see some uplift from their levels, it wasn't nearly to the same degree we saw out of the retailers, industrial shares, banks, for instance. So I definitely think there are opportunities there. We were looking at all our across our universe, the numbers that we expect from shares going forward on an internal rate of return basis over the next 3 years. And it's an exercise we do on a frequent basis, and it's always a good hard exercise to do because you get a lot of white noise thrown at you all the time, and it tends to be quite negative, and you start questioning things. So when you look at the hard cold numbers in reality, it often paints a different picture, and it tells you just to be patient.
You make mention of the run that we've seen over the month of September. I think the Dow was up around about 8%. At this stage, do you think that we could potentially see quite a dramatic pullback on the equity front in South Africa?
I don't think we'll see a dramatic pullback in equities anywhere in the world. There's clearly a hunt for yield on at the moment, and historically dividend yields, whether you look at them in South Africa,
ever
Europe,
again, or just in the short term? No pullback ever again?
Yeah, no, not in the short to medium term. Certainly not a 30 or 40% decline. But if we do get a pullback, I would expect 5 to 10% max. But just the yields and the return that investors can earn on those is extremely high relative to cash and bonds, and I think that creates a strong underpin.
The world has structurally changed.
Yeah, well, it's interesting you say that because that D word from 2007 I see has popped up in a couple of
You're talking about sovereign default now?
No, decoupling.
Oh, the decoupling.
Yeah,
is that what we're going to be debating for the next couple of months?
Yeah, I see a couple of reports have mentioned that, and particularly in relation to the IMF forecast, they're still quite sanguine about their 2011 forecast of 4.6% growth, and they're quite. They've got a lot of conviction in that number, and they believe that although the US is slowing, it's not going to have a significant impact on that number because we have in fact seen a partial decoupling in the world. And for example, they look at the BRIC countries, and they say total exports only make up 20% or exports make up 20% of GDP, and of that the US only constitutes 5%. So even if there is a significant slowdown in that country, as we're expecting for next year with growth to go to 1.8%, they feel global growth is on a trajectory, and it's likely to stay there.